Okay, so let's talk real estate investing. The world of finance, especially if you're juggling multiple properties, it can really feel like you're lost in a maze sometimes.
It absolutely can. Complex, shifting. Yeah.
Yeah, and just trying to keep up is honestly a bit overwhelming.
Yeah.
But what if there was like a strategic way through, a method to cut through that complexity and really boost your investments?
That's a million-dollar question, isn't it?
Exactly. So today we're doing a deep dive into something called capital stacking. And this isn't just jargon. It sounds like a really sophisticated financing strategy that's becoming, well, pretty essential for serious investors who want to scale up.
Crucial, I'd say.
Right. So our mission here, for you listening, is simple. We want to break this powerful concept down, show how it actually, turbocharges growth, and give you the understanding you need to really get why it's important and how it works fast.
Yeah, consider it a shortcut to getting up to speed on a pretty high-level strategy.
Definitely. Think of it as your fast track.
And it's so relevant right now because, let's face it, real estate markets are just getting more intricate, especially with these high-volume acquisitions we're seeing.
High volume, yeah.
The scale just demands a much more nuanced financial approach than maybe it used to. And that's exactly where capital stacking becomes, well, not just useful, but really essential.
Nuance, that's the word. We've been digging into some really fascinating material on this, trying to pull out the key nuggets for you. So, okay, let's unpack this. What exactly is capital stacking? And why is this sort of layered approach such a big deal for growing equity in real estate?
Okay, so at its core, capital stacking is it's a financing strategy, a sophisticated one. It involves deliberately layering different types of capital.
Layering, okay.
Yeah.
Like a cake, or maybe a building.
Yeah, maybe like a building is a good way to think about it. Each floor is a different financial instrument, with its own risks, its own potential returns.
Right.
So the foundation, that's usually your senior debt, think your main mortgage. Then, moving up, you often find things like mezzanine loans, then maybe preferred equity. And right at the top floor, that's your common equity.
Okay, so different levels of funding.
Exactly.
Yeah.
And the real genius here, the reason it's such a game changer, is how this layering transforms things. It takes something capital intensive, high barrier, like a big real estate deal, and turns it into this finely tuned engine for faster equity growth.
How does it do that?
Well, it optimizes the overall costs of your capital, it spreads the risk out cleverly among different investors, and ultimately, it maximizes returns. For, say, corporate investors or fund managers doing lots of multi-property deals, mastering this isn't just important.
It's essential.
It really is. It's the path to scalable growth. It unlocks different pools of investors because you can match the capital source to the specific project phase or risk level.
That makes sense. It's not just throwing money at it, it's structuring it smartly. And speaking of smart structuring, we came across a key voice here, Dr. Pooyan Ghamari. He's a Swiss economist, founder of the ALM platform.
Yes, Dr. Ghamari. His work is very relevant here.
He seems to really emphasize aligning these capital stacks with, like, the bigger picture, global economic trends, even down to individual investor types. What's his angle on this?
Dr. Ghamari's perspective is super valuable because he points out that a well-structured stack does way more than just manage risk. It actually significantly enhances your access to different kinds of investors.
Okay.
We're talking everyone from big institutional funds right through to, private high net worth individuals. And they all have different appetites for risk, different return goals.
Right, they're not all looking for the same thing.
Exactly. So his strategy involves tailoring these layers really carefully, using economic indicators, things like interest rate forecasts, or even really specific data like housing demand driven by migration patterns.
Wow, that granular.
Oh, yeah. It lets investors really fine-tune their yield while staying flexible. They can react to shifting market conditions instead of, being caught out.
That flexibility sounds key. What's really interesting here is how each piece, each layer, has such a specific job. Can you maybe break down those layers for us? What does each one bring to the structure?
Absolutely. Each one is distinct. So senior debt, like we said, that's usually your cheapest leverage, secured by the property itself, first in line.
The foundation.
Right. But, and this is important, it comes with strict rules, covenants. Things like maintaining certain financial ratios, maybe limits on what you can do with the property.
So less flexibility there.
Potentially, yeah. It can impact your operational freedom. Then you have mezzanine financing. This often fills the gap between senior debt and equity. It offers higher returns because it's riskier. It gets paid after the senior debt if things go wrong.
Okay, higher risk, higher reward potential for those lenders.
Precisely. Then there's preferred equity. This usually offers investors fixed dividends, like a regular payout, and they have priority over common equity holders if there are issues. It's sort of a middle ground, often more stable return than common equity.
A bit safer than the top floor.
Generally, yes. And that top floor is common equity. This is the ultimate ownership stake. It holds the biggest upside potential, the real home run possibility. But
The biggest risk.
exactly. They're last in line if the project struggles. So Dr. Ghamari's advice is really about calibrating these layers carefully. You look at the macro environment, the specifics of the deal, and you adjust the mix to boost equity growth and, crucially, avoid diluting the existing owners too much.
Finding that sweet spot.
That's the goal. Maximize leverage without taking on unreasonable risk.
I can see how that would be challenging, especially with the economy always shifting. It feels like trying to hit a moving target for investors. Which brings us to a really interesting point. How do these big global economic shifts affect these carefully built capital stacks? It seems like outside forces must constantly be pushing and pulling on them.
They absolutely are, and understanding those forces is, well, critical. Things like rising inflation, tighter credit markets, new regulations, they directly impact how available capital is and what it costs across all those layers we just talked about.
Right. So the price of debt or equity changes.
Exactly. And Dr. Ghamari really emphasizes that smart investors don't just react. They try to anticipate how lenders might behave and proactively tweak their capital structures.
Okay, anticipate. Like how? Can you give an example?
Sure. Let's say we're in a period where interest rates are climbing fast.
Okay, familiar territory recently.
Right. If you're heavily reliant on, say, floating rate senior debt, your costs could suddenly shoot up.
Yeah, that hurts the bottom line.
Definitely.
Yeah.
So in that scenario, a strategic move might be to actually increase your preferred equity or mezzanine layers, even if they seem a bit more expensive up front.
Why would you do that?
Because it helps protect your common equity. It prevents you from having to raise more traditional equity maybe when your valuation isn't great, which would dilute existing shareholders. So you maintain your buying momentum. Even if one part of the stack gets more expensive, you're trading off cost strategically.
Oh, I see. It's about maintaining the overall goal, even if the path changes slightly. That's a great example of adapting. So, looking forward now, what about technology? What role do digital tools play in managing all this complexity? You mentioned the ALEN platform. How does something like that change the game?
Oh, digital innovation is a massive factor here. It provides capabilities that just, well, didn't exist not long ago. Platforms like ALAN use advanced analytics. They let investors assess really complex risk-return trade-offs across all the layers almost instantly.
So faster decision-making.
Much faster and more informed. You can model countless what-if scenarios, see the impact on cash flow, on equity growth, on the whole portfolio's health before you commit any capital.
That sounds incredibly powerful.
It is. But here's where it gets really revolutionary, the kind of aha moment.
Okay.
It's the integration of things like tokenized investment solutions. Think e-gold, for example.
Tokenization. Like crypto, but for real estate.
Sort of. The brilliance isn't just about letting smaller investors buy fractions, though that's part of it. The really big deal is how it injects liquidity into assets that are traditionally very illiquid.
Liquidity, meaning easier to buy and sell.
Exactly. Imagine being able to trade pieces of a large real estate project or portfolio almost like you trade stocks. It fundamentally changes who can invest and how quickly capital can move within these stacks. It opens up new capital sources, makes the whole thing more flexible.
Wow, okay. That does sound like a paradigm shift.
Yeah.
Bringing that flexibility and access to big real estate deals. So for someone listening right now thinking, okay, I want to harness this potential, what are the practical steps? What's the takeaway from Dr. Ghamari's approach on how to actually do this effectively?
Right, let's get practical. Dr. Ghamari offers some really clear guidelines. First, you absolutely have to do your homework. Rigorous market analysis, understand the macroeconomic picture to guide where you put your capital.
Don't just follow the herd.
Precisely. Second, constantly balance the cost versus the risk across those layers: debt, mezzanine, equity. Make sure it lines up with how long you plan to hold the investment and your own tolerance for risk.
Makes sense.
Third, think about incorporating ESG factors, environmental, social governance, especially in your equity layers. This isn't just nice to have anymore. It appeals to a huge and growing group of investors.
Opens more doors for funding.
Definitely. Fourth, use those digital platforms we talked about, not just for modeling, but for clear reporting to your investors, making capital raising smoother.
Efficiency, transparency.
Yes. And finally, seriously explore tokenization. It's not just hype. It can genuinely enhance liquidity and attract different kinds of investors.
So those are the guidelines. But how do you know if it's actually working? If your strategy is paying off?
Great question. You need to track key metrics, things like your equity multiple, basically, how many times your initial investment you've made back, your internal rate of return, or IRR, that's your annualized yield, and capital turnover rates, how quickly you're recycling capital into new opportunities.
So measurable results.
Exactly. These numbers tell you if your stack is effective and signal when you might need to adjust your strategy.
Okay, so wrapping this up, what we've really uncovered today is that capital stacking.
Yeah.
It's not just financial engineering, is it? It's more about strategic thinking, smart design, and really unlocking potential in what we know is a complex market.
That sums it up perfectly. It's a truly powerful tool for scaling real estate investments effectively.
Elegant, even.
I'd agree. And understanding these layers, how they interact, especially when you factor in global trends and these new technologies, that's what really separates the investors who are thriving from those who might just feel, overwhelmed.
Seeing the whole picture.
Exactly, seeing the forest and the trees.
Well, we really hope this deep dive has given you a solid foundation, a real understanding of this sophisticated strategy. Hopefully, it's a shortcut to feeling in the know and more empowered in your own real estate journey.
Yeah, hopefully demystified it a bit.
And just to leave you with something to chew on, a final thought. Given how fast digital platforms and tokenization are evolving in finance, how do you think capital stacking might continue to change in, say, the next 5 years? Especially for individual investors who want a piece of those bigger, large-scale real estate projects.